Here we go. And it is 4.75. We got the 25 BP right along expectations. Not a surprise at all. Shouldn't see much movement off that. Now we got to get the summary of economic projections. That's the next big deal. Summary of economic projections. The statement is out. Implementation's out. Okay. 75 BP. Tighter conditions of credit for households and businesses and expect them to weigh on economic activity, hiring, and inflation. That's actually a big deal. That they're referencing tighter economic conditions. That amplifies the Federal Reserve's hikes, right? I'm trying to get the summary of economic projections, but that has not been posted yet. So let's just go ahead and go through their press release alone here. They say the U.S. economic system remains on resilient ground. We've got forecasts. Here we go. Median forecast, 5.1. They're keeping it stable at 5.1 on the SEP. They didn't go up and they didn't go down. I actually think that's bullish. They're keeping the same pace for reducing treasuries, holding on mortgage-backed securities, so no change there. That's interesting. 5.1. I really want to see that dot plot. Waiting for it to post on the website here. This is all coming through the wire right now in terms of these updates that we're getting. So waiting for, oh, here we go. Projections are out. And the projections, in my opinion, are the most important. And then we'll go through the policy implementation statement as well. So here are the summary of economic projections. Wow, I'm surprised. Look at that, folks. They kept the projection the same. They actually think they're going to, there's their higher for longer. Oh, okay. That's the higher for longer, going up to 4.3 instead of 4.1. Okay. Oh, look at that. They actually moved this slightly closer to recession in 2023. Usually they do not go under 0.5. That's interesting. Then they're actually keeping us out of a recession in 24 and 25. Unemployment rate 4.6, PCE inflation. And you can see the previous estimates here. They did reduce GDP both for 23 and 24 were reduced. So lower GDP in 23 by 0.1%, lower GDP in 24 by 0.4%. That's 400 basis points. Unemployment rate, they are refusing to signal any kind of increasing pain in the unemployment rate. Stocks, by the way, seem to be liking this. This is kind of what we wanted. This was my best case scenario, was 25 and dovishness. Now, I thought this might be a little bit more dovish right here, but that 5.1 on the median is a little higher than I thought. Look at this, folks. They're keeping inflation expectations for PCE stable, slightly higher for 2023, stable into next year. Core, slightly higher, but mostly stable here. No Paul Volcker, no runaway inflation. What were the ranges that we got for GDP? Look at that central tendency right here. Somebody's actually knocking on the door of recession. Look at that range right there. Change in real GDP, 0 to 0.8. That's a little bit of a red flag. That's a recessionary red flag right here. Look at that range. There's your recession. There it is. But we also had that range projected last time as well. So one of them is actually getting us a little bit closer to out of recession, whereas previously they also thought we might see that recession. The range is sort of the low versus the high, right? The median is a type of average, right? It's supposed to represent the middle. Let's look at the dot plot. What do we got for the dot plot? Wow, they're actually a whole lot higher than I thought. They're all consistent here for 2023 Q4, pretty much all staying above that 5% line. Now, I want to compare that to what we had in the last dot plot. So let's go to the last dot plot, which was right here. And let's go here. Kevin's estimates were wrong. So I'm going to erase these. So that looks pretty similar. You had 2 dots below for 2023, all of them above, with 2 dots as high as about 5.675. Going over here, yeah, you've really just consolidated around that 5.1 level. So they're sending a signal here that we still have 1 or 2 hikes left in us. So this is really telling us that we're going to get our March 25. We're not going to go down. We're not going to pause yet. We have to deal with what's remaining to be elevated inflation. I would say this is no signal of stress in banking, really. We are probably setting up for a May 25 as well. This will take us to 5%, right, on the lower bound. And a 5 on the lower bound is probably in line with that tendency of 4.1%. So the federal funds rate being at 5.1 rather, it sits right there in the middle of one more hike in May and then done. That's about where we sit. So one more before done. I think it's too soon to call for a pause. I expect Jerome will tell us he's being data dependent. That's not going to be much of a surprise at all. Looking at, the dots moved up a little bit. The Fed, let me see really quick what else we have here. What are the suits saying? Like most economists, the Fed does think that banking turmoil will affect the economic outlook. Recent developments are likely to result in tighter credit conditions for households. Yep, we expected that. You got Tesla popping off a little bit right now, jumping up about 1%. Looks like most stocks are trying to pump a little bit. Let's fix this here. Actually, let me try this. I have a new button here. Let me see if I break something by doing this. Oh, that looks good. Look at that. So we could keep that up while talking. Although I should move, whatever. Okay, anyway, so a little more adjustments to do. But anyway, I'm playing with this new board. Sorry about that. You'll get to experience it a whole lot more if you want. If you join the courses linked down below, you get all those private live streams. All right, Fed remains highly attentive to inflation risk, using interest rate tools to deal with inflation, using balance sheet to address financial stability issues. That's exactly what I thought they would say. That, look, we're going to keep going 25 BP because we got to deal with inflation. But guess what? We got a whole tool belt, baby. Oh, you got some inflation? We got some pepper spray for you. Oh, balance sheet problems? We got some handcuffs for you. We got a whole tool belt. You want to keep trying us? I think that's what we're going to get from JPOW here. Initial take on this per Wall Street seems to be slightly dovish. Does look like risk assets are moving up a little bit. Usually what happens, by the way, and I just want you to prepare for this. Usually what happens is we get a W, okay? So often, and not in this case because so far we're going up, but often we actually go down a little bit. I mean, maybe. I guess we still have 23 minutes. But oftentimes we go down going into the press conference. As soon as the press event begins, right here, stocks hit a little peak. Then, as he's talking, they tend to go down. And this is an average over the last 7 instances, what the stock market, the S&P 500 has done. And then towards the end of the day, they end up back up. So this is usually the kind of volatility pattern that you get per the average of the last 7 meetings from the Fed. But anyway, what do they say here? Inflation remains elevated. Modest growth. They did tick us a little bit closer to recession. Recent developments are likely to result in tighter conditions for households and businesses and weigh on economic activity, hiring, and inflation. Hey, well, this is kind of what they want. A little bit of a slowdown in hiring because of the uncertainties. The yield curve has steepened. Markets definitely see this as dovish. The committee seeks to achieve maximum employment and inflation at a rate of 2% over the long term. In support of these goals, the committee has decided to raise the target range for the Fed funds rate to 4.375 to 5%. The committee will closely monitor incoming information and assess implications for monetary policy. The committee anticipates that some additional policy firming may be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive enough to return to 2% over time. Yeah, well, if you refer back to the 80s, over time was 20 years. In determining the extent of future increases in the target rate, the committee will take into account the cumulative tightening, the lags of which we've already seen. Future increases is very interesting because so far they're really only pricing for another 25 BP, so we'll see what happens there. In addition, the committee will continue reducing its holdings of treasuries, so no change over here. And second page, nothing really. It looks like this was unanimous. Voting for monetary policy actions were everyone. And the committee's assessment will take into account a wide range of information, including readings on labor market, inflation pressures, blah, 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 blah. Okay, fantastic. So we got the 25 that we were expecting. Markets taking this as dovish, though. Usually right into the presser, we have, a little bit of a slowdown, so that's not uncommon. Stock market seems to do that in a row. 89 out of 100 economists were looking for 25, so this is really no surprise. A pause would have sent the wrong signal. I think overall this SEP is not as dovish as the best case scenario, but it's decently dovish. I was looking for a little bit of a drop on that Fed funds rate projection. So unfortunately, it does look like they're hitting us with probably another 1 to 2 rate hikes. If you look at their statement and you hear them say increases, it implies 2 more. And if you look at these projections here, it implies 1 more. So one to 2 more 25 BPers. They are acknowledging the tighter financial conditions, which that's what's leading to that softening in real GDP and the central tendency for real GDP. Fed's message is clear here. This is these are now the Wall Street suits, so let's say what they have to say here. Wall Street suits. The Fed's work isn't done. However, the median projection as to where rates will be year-end does show that officials are paying attention to stability concerns. Yes, in the fact that they haven't lowered it, or its optimism on inflation. Either way, dovish overall here. Bond yield steepening, looking for a little bit here. The language on ongoing increases implies some ongoing tightening. Yep, no kidding. Fed will continue, and we read through that already. Okay, so this gives you an update on what we got in terms of the 25 BP. My takeaways from this, all is normal. Okay, big bottom line takeaways before the Fed presser. Big bottom line takeaways for the average American, the average investor, whomever, okay? Big bottom line takeaways here. What do we got? We got, number 1, no Paul Volcker. There's no Paul Volcker. So if you're still sitting around really thinking the stock market's going to plummet on a pivot, you haven't listened to my explanation on a pivot. We've explained that many times before. I really don't want to go through it again. Basically, there's a pivot, and then there's the Fed U-turn. Generally, we want to invest where the Fed U-turn is, and U-turns usually coincide with not only a big mix in policy, but also bailouts, which we've started seeing some of those bailouts. So are we getting closer to a U-turn? I don't know, but we haven't seen any kind of Fed pivot yet. And honestly, I hate saying the phrase, but remember, folks, this pivot will occur when inflation ends. The market is worried about inflation not going away. Well, as soon as the Fed U-turns and changes directions, it means they have accomplished killing inflation to their satisfaction. The Fed is their problem in this cycle. In 2000, 2007, 2018, the Fed wasn't the problem. It was tech, it was real estate, and it was a lack of inflation. Those were the market problems before. Now, the Fed's actually having to respond to too high inflation, so the Fed's creating its own problem. When the Fed stops fighting its own problem, that's a great signal. That means they've accomplished their goals, at least to some extent. So anyway, I'm pretty happy about that. Overall, I think this is kind of along expectations. You know, we're not going to get a super dove here. We still got work to do. I was hoping it to be a little bit more dovish, but it's dovish enough, I think, to be satisfying to markets. It should give you confidence that we're not looking at a Paul Volcker. So that's number 1. Number 1, no Paul Volcker. Number 2, closer to potentially that accomplishing the mission, right? Number 3, we did get the Federal Reserve acknowledging that, yes, there are going to be issues because of the banking crisis. Those issues because of the banking crisis are specifically going to relate to tighter credit conditions. We've been covering those regularly. Those are likely to lower earnings per share for companies in the future. Specifically, in my opinion, SPY companies, S&P 500 companies, your consumer staples, your industrials, wouldn't surprise me. So Jerome Powell speaks obviously soon, but for me, average person here, no Paul Volcker is bullish. Overall, relatively dovish statement. Yes, still potentially looking at 1 to 2 hikes. And we'll see what Jay Powell has to say. Now, keep in mind how the market moves going into Jay Powell talking. I'm going to make this very, very clear. Out of the last 7 times that we've had these meetings, the average way that the market has moved is initially up, then you get a down, and then you get an up again right when Jerome Powell speaks. Then you get a down during his speech, and you end the day up. That's usually how the pattern goes. That doesn't mean this time can't be different, but that's typically what you see. So I think this is fantastic. Now, I know that some people say, oh, rate hikes are not bullish. I mean, the fact that some people were actually thinking there would be a pause here blows my mind. That would be more concerning. That would be concerning that something serious is actually wrong. Rate hikes at 25 are, in my opinion, very bullish because they mean nothing broke to an extreme level and we're not visiting Paul Volcker. If we were getting rate hikes to the tune of 1 to 2%, 75 BPs maybe over and over again, or 100 BPs, that would be bearish. A pause in this case, that would have been bearish. I mean, like, I don't know how you could say that a 25 BP is not a fantastic result so far. Again, Jay Powell will be talking soon, but this gives us a little bit of a heads up here in terms of a summary of so far what the statements show. Again, trending a little bit closer to recession, but the Fed refusing to really, at least in aggregate, believe that we are knocking on the door of recession. Remember, those estimates are an aggregate estimate of everyone. It's not like they collude on those, although they might anyway. The other thing to remember is today's coupon expiration day. So get the best price ever. Link down below. Prices go up over time, and you get a price match guarantee in the event they were lower for some reason in the future.